You're staring at your tax bill, and you're doing that quiet math in your head where you realize the state took thousands on top of the IRS. And then someone casually says, just move to a no-income tax state, like it's the same as switching phone plans. And if you've ever had that moment where Florida, Texas, or Nevada suddenly sounds like financial freedom, you're not crazy. Because for some people, it really can be a huge win, while for other people, it's an expensive move that barely changes the final number. My name is Hector, and I help you make tax decisions that actually hold up in real life, not just in a comment section. Here's the key problem. The phrase no state income tax is technically true in a handful of states, but your total tax burden is a whole ecosystem, and moving does not automatically erase your old state's claim on you. If you don't understand residency rules, income sourcing, and the taxes that replace income tax, you can end up paying more than you expected, or worse, paying 2 states and spending months arguing your way out of it. Stay until the end, because I'll give you a simple break-even test you can run before you pack a single box, and it will tell you whether moving is actually worth it for your income type, your lifestyle, and your risk tolerance. So first, which states have no state income tax? As of 2026, the list is 9 states: Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. That's the headline, but the footnote is the whole story, because Washington still hits certain long-term capital gains, and New Hampshire only recently joined the No Income Tax at All club after fully eliminating its tax on interest and dividends. Now let's talk about the most important nuance, because this is where people accidentally make the wrong move. No income tax usually means no tax on wages and salary at the state level, but it doesn't always mean you're escaping state-level taxes on investment income, business activity, property, or consumption. Washington is the classic example of why you need to read the fine print, because it doesn't tax wages, but it does impose a state tax on certain long-term capital gains above specific thresholds, which matters a lot if you're an investor, a founder planning an exit, or someone who sells appreciated assets. If you want more videos like this that translate tax headlines into decisions you can actually make, subscribe, because move for taxes is one of the most common topics people get wrong in ways that cost real money. Now, is it worth moving? And what decides the answer? The biggest deciding factor is what kind of income you actually earn, because the savings are completely different for a W-2 employee, a freelancer, a business owner, and someone living off investments. If you earn a salary in a high-tax state like California, New York, New Jersey, or Oregon, and you move your life and your work to a no-income tax state, the savings can be dramatic, because you're removing a state tax that often scales directly with your income. But if you're a remote worker, you need to slow down for a second, because in some situations you can still owe tax to the state connected to your job, especially if your employer is in a state that applies aggressive rules to remote work. Even when that doesn't apply, your old state may try to argue you never truly left, and that's why worth it is not only math, it's also proof. Here's the simplest way to think about the proof part without getting lost in legal vocabulary. States care about where you are domiciled, meaning where your true home is, and they care about whether you meet their residency thresholds. And big states with lots of outbound movers often audit residency aggressively because there's so much money on the line. So if you move, you want your life to tell one consistent story. You have a real home in the new state, you spend most of your time there, you move your driver's license and registrations, you update voting, you change doctors and dentists, you move your important stuff, and you stop acting like your old state is still your base. If that sounds intense, it's because it is. And the reason is that a tax move only works if it's a real-life move. The easiest way to get burned is to move on paper. Keep your old apartment. Keep spending most of your time in the old state. Keep your social and business life anchored there. And then act surprised when the state says, you never left. Now let's do the money side in a way that makes sense fast. People obsess over income tax and forget the replacement taxes, which are usually sales tax, property tax, and other fees that fund the state. Texas is a perfect example where you might save massively on income tax, but you could face higher property taxes depending on where you live and how expensive your home is. Florida can be a win on income tax, but homeowners insurance and housing costs can shift the equation. Nevada can look amazing until you price housing in the parts people actually want to live, and until you notice how much you pay through sales and tourism-driven taxes when you're just living a normal life. So the real break-even test is not how much income tax do I save, because the real test is how much total cost do I save after I account for housing, property taxes, insurance, and the fact that moving itself costs money. You calculate your expected state income tax savings, then you subtract the extra annual cost of living in the new place, and then you subtract the one-time moving costs spread over a couple of years so you're not lying to yourself. If the remaining number is still big, consistent, and worth the lifestyle change, then moving can be a smart, rational move instead of a tax-themed fantasy. Now let's make this personal with a few common scenarios, because that's where you'll recognize yourself. If you're a high-earning W-2 employee who can genuinely work from anywhere, moving from a high-tax state to a no-income tax state can be one of the cleanest tax wins available, as long as you actually relocate your life and not just your mailing address. This is especially true if you're getting bonuses, equity compensation, or large annual payouts, because removing a state income tax can change the after-tax result more than almost any deduction hack ever will. If you're a freelancer or self-employed, the savings can still be great, but you also need to look at the business side taxes, because some states make up revenue through gross receipts taxes, franchise taxes, and higher fees that hit businesses in different ways. The win is still real for many people, but the calculation should include your business structure, your margins, and whether your clients are tied to a state that will still tax income sourced there. If you're an investor or you expect a liquidity event, you need to be extra careful, because the state that taxes your gain is often connected to your residency when the gain is realized, not when you first had the idea to move. That's why timing matters so much, and it's why Washington's capital gains tax nuance matters if you're moving there specifically for no income tax, because your wages might be untaxed, while a big asset sale could still trigger a state bill. If you're retired or living on investment and retirement income, a no-income tax state can be a strong move, but the real drivers often become property taxes, healthcare access, insurance costs, and whether the place you move actually fits your day-to-day life. Plenty of people win the tax math and lose the lifestyle, and that's not a great trade when you're trying to enjoy the freedom you already earned. If this is helping you see the difference between the headline and the reality hit like, because it helps more people find the practical version of this topic instead of the oversimplified version that creates expensive mistakes. Now, let's talk about the biggest trap, because it's the one that turns tax smart into tax messy. The trap is assuming moving is a switch you flip on January 1st, when it's actually a story you have to defend for an entire year. Most moves create a part-year resident situation, which can mean you file in both states for the year you move, and you may still owe tax on income tied to the old state even after you leave, especially for things like income sourced there, deferred compensation rules, or business income connected to that state's activity. So if you're planning a move, the smartest step is to plan it around your income events. If you're going to sell stock, receive a massive bonus, or close a business sale, the question becomes not just where you want to live, but when you become a resident, in a way the old state cannot reasonably dispute. This is exactly the kind of moment where a 1-hour consult with a good tax professional can save you 5 figures, because the cost of being wrong is so much higher than the cost of getting clarity. Here's the quick framework I promised, and you can run it in about 5 minutes with honest numbers. First, identify the income that would actually be taxed by your current state, because some income types are treated differently, and you want the right base. Second, estimate what you would pay in state tax this year if you stay, and compare it to what you would pay if you truly relocate and establish residency in a no-income tax state. Third, add the replacement tax costs, meaning your expected housing costs, property taxes, insurance, and sales taxes based on your spending habits, not on an average person you don't resemble. Fourth, score the lifestyle fit, because if the move makes your life worse, you will either move back or you will resent the savings, and both outcomes are expensive. If the savings are large, the proof is defensible, and the lifestyle fit is real, then moving can be worth it, and it can be one of the cleanest legal ways to keep more of what you earn. If the savings are small, the proof is shaky, or the move is mostly an address change, then it's usually not worth it, because you're trading stability for a tax benefit that may not survive scrutiny. If you want a simple tool to do this without guessing, I have a no-income tax move calculator that plugs in your current state, your income type, your expected move date, and your likely housing costs, and it spits out a realistic estimate plus a residency proof checklist so you don't accidentally do the one thing that makes your old state say, "Nice try." Use it before you commit, because the best time to avoid a residency fight is before you create one, and the best time to find out moving is not worth it is before you spend thousands relocating for a benefit that disappears the moment the numbers get honest. Which means if you're going to do this, you do it with clarity, you do it with proof, and you do it for a life you actually want to live. Because the real goal isn't just paying less tax, it's keeping more money while building a life you don't want to escape from. And once you see it that way, the right answer becomes obvious, and you either move with confidence or you stay with a plan. And either way, you stop letting a headline push you into a decision that should be driven by your numbers and your reality. Starting now, before the next big paycheck or exit moment locks in the outcome, and you realize too late that the best tax move wasn't a new state at all. It was making the decision early enough that you could still choose the outcome on purpose. Notes, not for voiceover. Sources used include Tax Foundation and state revenue guidance on no-income tax states and Washington's capital gains tax, plus New Hampshire Department of Revenue on repealing its interest and dividends tax.